we believe that the desperation is more on the part of the US than on the part of India to do a deal with us.
People have invested in gold, and gold has done fantastically well, right? Even in fact, silver has done very well.
You don't want the markets to have a huge surge because the faster they move up, the faster they come down. Year to date, India has underperformed the MSCI Emerging Markets Index by 18%. 18% is that.
Yes.
The
That's
world
the,
index.
that's the worst in 15 years. Good evening, everyone, and welcome to another episode of Market Pe Charcha with me, Devi Prasad Nair, and I have with me, as usual, our MD and CEO Dinsha Irani to take us through and answer some of the questions which we have on behalf of all the participants and partners. During the conversation, if you come up with any questions, I would request you to type in your questions in the Q&A box up there, and I shall take that towards the end. So thanks, Dinsha, for the time once again. And so straight, we've been, talking since we started the Market Pe Charcha. We've been talking about the challenges which our economy was grappling with. In fact, we did mention that rate cut was imminent, and consumption was, or demand pickup was a problem, and so on and so forth. And we've been seeing that the government proactively acting upon it. In fact, the recent GST thing which has also happened. What next? I mean, what do you think is now required for the market to show that animal spirit which is yet to come in the market? So let's begin from there, and then I will take it forward thereon. So
Okay.
your views on that what next?
Okay, thank you, Devi. Thank you and thank you all the participants for being on the call. So let's start with the fact that, by the way, one thing that I want to tell everybody is that I think that the additional 25% duty that was applied on us by the US was probably a godsend opportunity for the markets, because not only did it help the markets correct and the participants who are remaining outside to get into the market seeing a correction come in, but I think it basically jerked the government also out of its somberness as such, that they realized that we need to do something different to not only overcome this gundagardi of the US, if you can call it, I mean, hooliganism by the US, literally it is that way, but also the fact that we need to do something for the domestic economy, because we cannot be depending on exports alone. And that's why that announcement by the Prime Minister on the ramparts of Red Fort during his Independence Day speech, I think that was basically forced upon us, thanks to what the US was doing in punitive actions that they were taking on the duty front on us. So that was a godsend, actually. And I feel that that has gone a long way in probably our thesis of always saying that we need some push for demand to start happening. And very judiciously, by the way, the duty structure has been reduced from 4 duties of 5, 12, 18, and 28 to 2 duties now. I'm talking about GST, is 5 and 18, right? Which is a very big positive, because now it not only makes it simpler, but also it pushed most of the 12% slots to 5% and a bulk of the 28% to 18%. So basically made goods cheaper at the 12% slot by 7%, and the ones at 28% at 10% cheaper. So that way, yeah, there is another 40% sink tax, which is mainly for super luxury and for all these cigarettes and tobacco and alcohol and stuff like that. So that's been put there, but that's a very minuscule portion. So bulk of it does that. And the beauty of this whole thing has been that the impact on the GDP is roughly around 15 bips to 20 bips, which is not too much. I mean, I'm talking about the offset which has happened. But in a way, I think my feel is that also hit won't be felt because most of these goods which have become cheaper, there'll be a lot of demand, pent-up demand, which is yet to come in. As I said earlier also, that the government does not the government, the RBI has done its bit by infusing enough liquidity in the system, by cutting interest rates. So basically, there's a lot of liquidity lying around at very cheap rates. Right? All he needed to do was give a spark for that demand fire to take place. And I think the spark is this cut in GST, massive cut in GST, which will see that happening. And very judiciously, this government also has made it clear that this GST cut will be effective from 22nd of September. Now, we are in India, there's a Shraddh period going on, and that gets over on 22nd of September. Rather, 21st of September is the last day of Shraddh, and 22nd the Navratra Shraddh. So you can imagine that huge euphoria which is going to hit the markets as such. Suddenly you'll see that on one day, you'll see a morning newspapers announcing that massive Navratri dhamaka, rates have cut by so much %, and you can imagine the animal spirits kicking in at that point in time. Also the fact that most of our analysts, my analysts out there, were on the field just doing this kind of work. In fact, they were in the microcosm of UP, Uttar Pradesh, which is actually a microcosm of India as such. And they were trying to gauge rather, meeting all these retailers and stuff like that. They've been doing that for the past couple of days, whether the demand growth is expected to grow. And mind you, Devi, I mean, the feelers that we got from those retail outlets, it's going to be a bumper festive season, actually. 1 month from 22nd of September to 23rd of October, which is the whole Diwali season packed and the festive season packed together within a month's time. I'm sure there's a huge pent-up demand which is going to hit. You'll see a lot of offtake happening. You'll see a lot of good news happening. And obviously that will reflect in the results. That will also reflect. And by the way, I don't know, most of you must have seen those news bites which are now coming out, that the private sector, which has always been on the back foot in terms of capex, is now also kicking in with its capex, thanks to the fact that they're seeing this pent-up demand coming through and they're seeing utilization levels moving up. And as a result, the capex is coming in. And the beauty about this capex, the private sector capex, is it leads to a lot of employment generation. And when you see a lot of jobs getting created, the consumer gets more and more confident on his sustainability of his income. And that's why he keeps spending. So now you see that reverse spiral happening, confidence coming back, coming to the private sector increasing the capex leads to more job creation leads to more job creation, more confidence on the part of the consumer, and this keeps moving up. So this is what we were waiting for, and I have no doubts now that we are in the midst of this, and probably from 22nd September, you'll start seeing that offtake happening, and you'll see that trickling down even to the numbers of the corporates, which unfortunately till now hasn't been that great as such. So those numbers will start showing probably in the quarter of December, but obviously the markets will discount it probably a quarter earlier, and you'll see a decent rally. And by the way, one more thing, despite all the negative news that came by, the markets are very resilient. Even today, the markets are slowly crawling up. And this is what you want. You don't want the markets to have a huge surge, because the faster they move up, the faster they come down. It has to be a steady rise, and that's what our market is doing. It's behaving like a very mature market, and that's how it's moving. If you were to ask me on, so obviously the other question that you would be having is that when do you think the FIs will come back? I mean, I'm just preempting this right now because I think it's a very intrinsic part of this whole argument that we are putting through right now. So on the FI front, now look at it as an FI, right? The fellow has not come to India. He's sitting outside, waiting outside. But what he's seen in the interim is, year to date, India has underperformed the MSCI Emerging Markets Index by 18%. 18% is that.
Yes.
The world index.
That's the worst in 15 years. Yeah.
Yes. Yeah. This is year to date. I'm talking about just year to date from 1st of Jan till today, right? Now, the MSCI World Index is underperformed by 12%, which normally we never should do. We always used to outperform the world index because world index used to consist 65% of US, and the rest used to be, China used to be around 8-9%, and the rest used to be the whole world together, right? India used to be around 1 or 2% of that part. By the way, our 16% weight that we come down in the EM index is also one of the lowest in the last 5 years as such. So it's obvious that our massive underperformance has led to this kind of a weight in the EM index. So now, one, he's seen that. Secondly, he's seen the Indian currency depreciating constantly against the USD, right? While what he's seen in the US is, if he's sitting in the US, he's seen the US dollar depreciating against most of the other global currencies, roughly around 8 to 15%, depending on which currency you're looking at, right? So that's the kind of depreciation the US dollar has seen. But India has seen a depreciation against the USD. So as a result, India's currency has depreciated far more vis-a-vis the other global currencies, right? So that again is a very big positive for us because he's already seen that done and dusted, right? Thirdly, on the valuation front, we come back to our not even 10 years, it's around a 12-year average valuation that we come back into, right? Because our massive outperformance or the massive premium that we commanded is now down to reasonable levels. So all in all, everything seems perfect. All he's waiting for is the trigger, which I said would be probably the numbers which will come out. And according to me, even the September numbers, the September quarter numbers, despite 1 month of no sales happening, thanks to the early announcement by the Prime Minister on 15th of August, which has held back big purchases till now, I think the numbers will be more or less a double-digit kind of growth because, as I said, September last year was a very bad year. And when he sees this kind of demand offtake happening, when he sees these positive vibes coming by, you will see the FIs coming back in. So I have no doubt that probably from next month or the month after, you'll see a lot of positive flows on the FI front also going forward.
So that's it, Dinshaw. I mean, do you see that it's a setup for a tactical rebound in Indian market? I mean, because, we are like, if you look at 12 months, you talked about FITD, but if you look at 12 months, we are down about 24% vis-a-vis the emerging market basket, right? We are at the, I think we are the, lowest of holdings in there. So do you see that, and then most of the markets have done, fantastically well, right? All the EM basket. So do you see that, that there'll be a tactical rebound even otherwise in India if the tariff problem was to tackle? Or another thing to this is that if the tariff problem, say it gets extended, right? Then where does this entire change in the demand environment takes us? I mean, will it like really have a positive impact, or it will just under the tariff issues get settled there, and people get worried about the tariff worries takes over there?
So, okay, Devi, as I said, the tariff was a godsend. I mean, I did not apply that additional 25% penal duty on India. We want to see the correction that we saw. We want to got the opportunity to get back in the market, and we want to see the government shaken up to do what they did. So it was I would take it as a positive, right? But anyway, there's both sides of the sword, the two coins, sorry. So that way, and so what happened was happened. But if you ask me, and if I don't have a crystal ball with me, but my gut tells me the sound bites that I've been hearing from the US. In fact, if you guys remember, we were very clear in the very beginning also that India, the deal is not going to happen because of the staunchness of India's approach towards agriculture, rightly so, right? So now that we're hearing these sound bites, we believe that the desperation is more on the part of the US than on the part of India to do a deal with us. Why I would say so is because it's not because of that we supply something which is very different from the world in the export front, but I think they need India on their side purely because of geopolitical conjunctions. They do not want to lose India to a China, right? And frankly, I mean, I don't think we are also that keen. If we are dealing with China, we are dealing on equal terms. We don't want to be on a lower term when we deal with China, as I've always said earlier also, that we are 100 billion plus market for China. So they might as well respect the biggest customer, that one of the big customers that they have. I don't think US wants to do that. US wants us to be in their good books. Rather, they want US to be in their good books, in India's good books. And that is why my belief is that if push comes to shove, probably by November, you'll at least see that 25% penal duty being reversed, irrespective of whether India is buying the oil from Russia or no, won't matter. It'll get repealed. And secondly, my feel is that even the 25% duty will be rolled back to more reasonable levels. So you'll see very much positive news coming back to India. We'll be probably in one of the MFN status countries, most favored nation status countries as such going forward. And that's what my feel is. I may be wrong, but I think I'll be more my probability of hitting the right chords will be much more, right? So that's on the positive side, right? And frankly, I mean, you said it's a tactical move that India can see. That is definitely possible because India has underperformed massively. My feel is it's going to be a structural move from here on. If all these dominoes fall into place, the penal duty going away, we being treated as an MFN country by US, and obviously the 25% duty being rolled back to more reasonable, say 15% or so, I think we'll be in a very strong footing and we'll enter the next calendar year on a very strong note. And my feel is from here on, at least we have at least 5 quarters of bad growth rate earnings. So you'll at least have 5 quarters of positive growth rate in earnings. And that is what the FIs will look at. The valuations will, anyway, as I said, are back to 10-year or 12-year averages as such. I think those valuations will come back to something like 5-year averages, which is again 20% away from what we are today. So you can very well imagine what we're talking about here. And plus, if the earnings start picking up, you'll start seeing re-ratings happening on the analyst front. So even the Ps which are at 20 today may, if you revise the earnings, may look at some 17, 18 Ps. Now, from the historic levels, you're away by around 30, 40%. So that's a huge move we're talking about in the market. If that, I'm not saying it's going to happen, but that's what my feel is, that I think we are in for a very, not even a structural, but a more, not a technical, but a more a structural rise going forward. And that's why we are very bullish. And I've always been telling everybody that we normally try to time our new funds, right? And we timed the mid-cap fund perfectly when we brought it out in the end of Feb. And after that, you've seen what's happened to that fund. Even the small cap fund, I think the timing is perfect. We plan to launch it in November, right after the festive season is over, and when all these small cap guys are going to be talking very bubbly about their future and all. I think that is when we're launching it. I think it's a perfect timing for that fund to come in as such. So that way. So I have no doubts that we'll be back in a healthy market going forward very shortly.
Yes, of course. I mean, if India, so what we're talking about the growth coming back, and if that growth comes back, and if India has to double or triple its GDP from here, I think small cap, these companies, small and mid cap companies would play an integral part of that. So Dinshaw, taking it forward from the small cap thing which you mentioned, you straightforward came into that, which says that how bullish you are on that, because you didn't even discuss about large caps, right? I think they are sort of this somewhere I think the music is sort of going down there, and somewhere you feel I think small cap and mid caps looks much better. Of course, the kind of result we have seen after taking the mid cap call, but in the small cap space, Dinshaw, I mean, do you really see it actually coming out from here? I mean, small caps, what are the trigger points? What are the trigger points which are making you feel that now, look, this is, I think it's time to take bets, larger bets, and take good bets on the riskier asset class, which is basically mid and small cap. So first question, whether mid cap or small cap or both. And the second thing is, which sectors do you think that will be part of the small cap cycle in the next cycle, if at all you think that this entire cycle is going to revive from here? Because people often mistake volatility for risk, and amidst that they end up missing, or they there has been calls of stopping mid cap SIPs and all that. And when I'm talking to people recently also, I heard people talking about small cap looks very riskier, and the valuations are stretched. So what are the points which you are looking at, which maybe people are ignoring? If you could just take our partners through that, would be of great help.
So, okay, basically, I don't think there's a distinction between small and mid caps. Nowadays, the mid caps are more of large caps, and small caps are more of mid caps, right? That's how it is. So let's not even talk about that. On the returns front, the whole beauty about small caps is like 150 stocks, right? And the mid cap, sorry, is 150 stocks, and the small caps is 250 stocks. Okay, that's the index we're talking about. When a mid cap does well, it moves out of the mid cap index and moves into the large cap index, right? The Nifty 100. So basically, the best growth phase is not captured by the index, but by the large cap index. When a small cap does well, it moves into the mid cap index. So the best growth space is captured now by the mid cap index. So that is the problem with these two indices. You can never trust the numbers that you see. So if you track a mid cap and small cap index, you'll say, oh God, they don't do too well. They've done well, but not as well as we expected them to do, and stuff like that. It's because the movement happens at the best phase of the life of that particular stock, from a small cap to a mid cap. So that's why mid cap will always be underperforming. Sorry, a small cap will always look as underperforming the large cap index, mid cap rather index, because the small cap, the best growth is captured by the mid cap space. And most of the move happens from small to mid, right? Some of the mid caps move into small cap space and stuff like that. But still, that is what happens here. And as a result, you'll see that mid cap will always look as a very healthy index as compared to, in terms of performance, as compared to small cap. Only phases you'll see the small cap moving up and stuff like that. What we've done, however, when you see our portfolio, I mean, you've seen a lot of names out there which are in the small and mid-cap space. And mid-cap, unfortunately, just 150 stocks. So you'll see a lot of 150 stocks being represented in our portfolio as such, as part of the mid-cap, right? Normally, the biggest mistake that a manager makes in a small cap is he gets carried away by probably the earnings growth of a stock and forgets that there's a lot in the back end that needs to be checked, just apart from the earnings growth that a stock brings. This is in the small cap space. The management is paramount. Right? The accounting is paramount. Their corporate governance is paramount. You need to be squeaky clean for your small cap to make it to a mid cap space. And I think that's where our philosophy really kicks in. The initial investing philosophy that we follow to the T is what helps us in identifying these quality small caps, which are assuring you quality management, good corporate governance, good accounting, and probably to an extent some growth also, because they won't make it to the thing if there's no medium triggers or no valuation boosters. So that's what it assures, and that's why our strike rate in small cap is much higher as compared to what you may see in the market as such. So that is what I would like to bring to the table, and that's why I said that when you look at our small cap fund, and in fact even today, I always throw this challenge to any distributor where I meet, that you see my stocks in the space, and if you can identify any stock where you know that the management is corrupt or the accounting is wrong, I'll be more than happy to eat humble pie saying that this, but nobody has ever done that with me thus far, touch wood, as now. So I don't see that changing even in the future when we bring our small cap fund as such.
So taking one more question, which is there on that, what's your view on the rate cuts in US? If they cut, what would be the impact of that? Because, another thing which I wanted to check with you is this, that the currency has, there is a typical thing which is happening that, when your CADs were higher, earlier we have seen that, it used to impact your currency, but, in fact, with the lower CAD, the currency has hit the lowest, this time rupee. So where is it, taking us? I mean, what's your view on that?
So basically, Devi, if you guys remember, I always used to say that the earlier governor had probably stretched his view on inflation a bit too far by controlling the currency, by sucking out liquidity and impacting demand. So basically, he kept the rupee stable against the dollar when every other currency was depreciating against the dollar. However, we let go of this constraint because demand started suffering, and the new governor was very clear that he wanted to increase demand, and that's why he wanted to push in supply of rupees into the system, make money cheaper, right? Basically, the helicopter Ben style of managing recession, right? So throw money at consumers, and they will buy. Right? That was all about, and it should be cheap money. So that's what he did. And I think that's because of this supply of money now coming into the system, the way we had held back the rupee dollar rate artificially, I would say earlier, just came back as a rebound, right? And today we're paying for our past, I suppose. If we had let it go earlier, I'm sure the rupee also would have been much more stable as compared to the dollar today, but unfortunately we didn't. We held on to our currency earlier, and today we're paying the price for that, holding on to that currency. And I don't see that. I see that reversing pretty shortly. I think the rupee should stabilize somewhere around these levels, probably hit a 90 if you will, 89, 90 if you will, and probably from there it will be stable or slightly reversed from those levels as such, because that's what the real was showing us to be, right? Real effective exchange rate was showing us at that levels anyways. So that is one. And secondly, my feel is on the interest rate cut front, the jury is still out, right? The markets, if anything, have taken a slam dunk approach that it's going to happen. So is the debt market as such. But the recent data on inflation has proved otherwise. So I'm sure the Fed is in two minds. But because of the kind of hankering that the Fed chair has got, Jerome Powell, I'm sure he'll bow down to that and probably do a 25 bip cut. But I don't think that's going to impact the overall lookout in the US as such, or the overall currency impact as such, because if dollar becomes cheaper, I mean, as in the investing in dollars becomes cheaper, obviously people move to other currencies, so that should be beneficial to our INR also as such. But let's see how that goes. But I don't think it's going to be that slam dunk approach on part of the Fed also, because they're worried. They're worried that this. By the way, whomever we talk to, all the exporters from India, the first 25%, they told us that 70-80% has been absorbed by the buyer and not by the seller, because the seller margins were anyway 7-8%. They're going to absorb the 25%. So bulk of them have moved to the buyer. Indian companies have absorbed 3-4% as such, and 20-odd% are being paid by the buyers. So that's inflation actually out there. Even if they do not pass it to the consumer, it's a wholesale price inflation, not a CPI, but a WPI. But that will ultimately trickle down to the consumer as such. And as a result, you see inflation moving up. So that's why the Fed is being very cautious, and I don't think that's going to be a slam dunk approach.
And how about you see how you see the Japan and other global factors playing out? The rate hike expectations in Japan.
So every other country is nowadays dealing with a higher interest rate scenario, right? In the sense that the inflation is moving up. That way, India is a slightly and very attractive destination, right? India inflation is lower, interest rates are lower, so you'll see a lot of interest coming back to it. That's why I'm saying it's playing out to be a story into the hands of India. I mean, Japan has never seen a 3.5% kind of interest rates. They're seeing that. Right? EU has never seen like 3.5-4%. They're seeing that. Same is the case with the US. I mean, the Jerome Powell is very reluctant cutting rates, so he will, but still a 4% is too far out a cry as compared to what they were used to of 1.25% as such. So that way, India is better placed as compared to other global economies. And I don't see that happening per se. One more thing, Devi, as I said, that it was a godsend on the part of India that they applied those penal duties, and it forced us. It forced us to even look outside of US. Till then, we thought he was our friend. We realized he's not a friend of anybody, and as a result, we started doing coalitions. We went and met EU. EU guys were more than happy to do deals with us. We met Japan. Japan was more than happy to do deals with us. We met China. China, in fact, brought on Russia along with them, and we were a coterie which was doing fairly great. So I think that coalition that we've been forming, the friends that we've been forming besides the US, I think that has dealt a real concerning blow to US, and that's why that forced them on back to the table, saying that look, we can't afford to lose India to at least a Russia, or a China, China or a Russia, if you will. But EU and Japan can be very thick partners with us, and these are big economies doing big businesses, right? Japan is the third largest economy as such. So EU put together is the fourth largest economy, right? So India is the fifth largest now. So that's how it will be.
Disha, there's one question on large and mid cap fund. Can you put some light on large and mid cap fund? Okay, I mean, you want to take that question on large and mid cap?
On our large and mid cap fund?
I think, yeah. I think
no,
it's
I haven't seen the question. So okay. Anyway, okay, light and mid cap. Okay, there's some light on that. So basically, what we've done is, Devi, that in our large and mid cap, as I said, that most of the time, the whole logic of the large and mid cap was we were very clear. It's going to be a true to label fund, and that's why you will not see a single small cap in that fund. We have one small cap, unfortunately, which we thought would turn into a mid cap, but that continued to be a small cap thanks to the penal rate of 25%. It was supposed to be a garment exporter that we are looking at as such, so that way. But if you look at the mix of the composition of that fund, it is mainly 50-50. 50 large cap and 50 mid cap. One small cap, which is like, I think, 1 or 2% or so. But that's how it is, right? The whole idea of that fund was to equalize the weights of the two and then play along with it. We could have very well played as 65 large cap. If we were to be very conservative, we could have done that. But as of now, you're seeing that the weight of the mid cap is now slowly moving up as compared to large cap, right? That was the whole logic of that fund, that we will try to, whenever we see the opportunity, we'll change the mix in favor of the mid caps and bring them a majority as compared to the large caps. And whenever we see panic in the market, we'll up like a break and paddle, right? Up the stake in the large caps and increase the weight there. But today, it's more or less 50-50. And that's what the composition, I believe, of the index is also. It's 50-50 mid and large cap index. And we'll keep it there, but we'll try to up the weight of the mid cap to an extent going forward. So that's the whole logic there. And that fund also, Touchwood, has done very well. We're very happy with the performance of that fund.
So, Dinshop, so which are the sectors, what is the sector-wise outlook, or which are the promising sectors which we are looking at from a next 12-month basis? So we are saying, or what we are alluding to is that growth will come back, risk appetite will come back. And in fact, we are also saying so that after the growth will come back, maybe FIs will also come back. So if FIs come back, will they be focusing on the large cap based sectors, or which are the sectors which you see will
So okay, basically, I will spin it a different way. Suppose I was an FII and I was raising money in the US, and the US investor was looking at investing in my fund, which is going to invest in India, asked me that, what are you going to buy in India? And I'll tell him, look, I'll buy these lovely cement stocks. I'll buy these beautiful FMCG companies and stuff like that. The guy will ask me to take a walk because he can very well get that in the European region or something. So you have to be different as compared to, and that's why we believed this always. And that's why we always had these unique names. Though we are BFSI heavy, right? Because that's, and by the way, BFSI heavy, we are not because we love that particular space. But we've seen that globally, I mean, as in the past, whenever the economy does well, the BFSI sector does far better than the economy does, because that sector is the one which is really giving you the fuel for growth in the economy which is running, right? So that's why I like BFSI. But besides that, probably I haven't done this maths, but I think the percentage holding that we have in new age companies may be one of the highest as compared to other mutual funds that we have.
Yes.
This is taught to us by our offshore fund. We have a FPI license also, and we operate a fund out of, we as in the parent runs a fund out of Singapore. And that fund buys these kind of unique names. And that's what made us believe that this is where the real juice is for the country, because this is a very differentiated offering that we have to offer to all FIs. And when they come back, these are the spaces that they'll come back to, and they'll start buying these kind of platform companies, be it a Paytm or a car trade or a PB fintech or an Indigene or whatever you, I mean, Zomato or Swiggy and stuff like that. Even, by the way, Urban Company now, the anchor list has come out, and most of you would have seen our name in that list as such. That's one more conviction idea for us going forward. I think these are the kind of unique names that one wants to buy. That's why in our portfolio, you'll now see two EV players, right? Ola and Ather, both together, both the only two EV plays, which are pure EV plays that are there in our portfolio. Thanks to the GST push, you will see that there are two more two-wheelers added to our portfolio, which is Hero Moto, and that's reported, so I can disclose that name to you. Hero Moto and Bajaj Auto. You can imagine, I mean, as I was telling one of the channels, that I couldn't have ever imagined owning 4 two-wheeler plays in this country, because we never used to like auto space. But I think the two-wheelers have done wonders, and EV is the way forward. And obviously these two regular two-wheeler ICE buys are mainly because of the push that you'll see from thanks to the GST cut. There the GST is gone from 28 to straight away 18. So you'll see a lot of offtake happening there. So these are the kind of plays that you look at. Obviously, when the discretionary spends improve, the easiest bet would have been to go and buy an AC company, right? Or a refrigerator manufacturer. But that's not how it works, because that already I was discounted, and that's why those fees were very high. So you look at derivatives beyond that, right? Which are the ones which will derive growth because of this. So obviously platform companies was one, hospitality is another one, hospitals is another one. These are the kind of plays that you look at which are different from what the regular run-of-the-mill is, and that's why you go and buy these kind of plays as such, and that's what you will see happening going forward. We didn't have to change, by the way. One more thing I must say is that despite this huge reversal in GST, I mean, as in the way the GST was brought about, or the fact that the penal interest rates were applied and India had a tariff issue and stuff like that, we didn't have to change our portfolio, because our focus was very clear that we're looking at the internal economy, not the external economy. And that's why we went along with all the internal consumer plays that we wanted to.
Then sure. So another question is now, equity has been slightly not performing well for quite some time. So there has been, that people have invested in gold, and gold has done fantastically well, right? Even in fact, silver has done very well. So what's your outlook on these two asset classes? I mean,
So, okay, Devi, never will any investor have 100% of his portfolio in gold or silver. He may have 100% in equities, but never 100% in these precious metals. I always say that you should diversify your investment. And very grudgingly, I can tell you that always I've been saying that Trump is a lot of uncertainty for this world, right? Gold rises only in uncertainty or high inflation scenario, right? Trump is both. So basically that is why gold and all its derivatives, all precious metals, are doing well because of this reason. Now, till this reason continues, gold will keep doing well, but obviously equities will do even better than gold. My belief is going forward, because the returns will be much better than gold. Gold will do well, no doubt about that. I don't think gold will go off the cliff or something of the sort. But equities from here on, my belief is, or from probably a month out, my belief is they'll do far better than gold would or any other precious metal would. Because as I said, Indian equities at least, as I said, that my belief is that all things are coming together for a perfect, not only a tactical, but also a structural move for our markets as such. And those who have missed my earlier speech can please go back to the recording whenever they put it up on the site, and you see the arguments that are given out for the same.
So I think that's it. I think I have no more questions here, Dinshaw. And I think we could cover beautifully our expectation from the market and what we are making out of these cues coming in from the market. So thanks for that. And thank you very much, participants, for joining us today. In fact, I really apologize for the technical snag which you would have faced. We will ensure that we fix this for the next one, which we will do it on 9th of October, same time, 4 o'clock. Until then, stay safe. See you and bye-bye, and see you soon. Thank you so much for joining us.
Thank you, everybody, and apologies once again for the patchy video and audio. Thank you.
Thanks. Bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.